What's up, family? Andre here. In my last video, I talked about the top 10 economic reports that every investor must know to stay on top of the market. In today's video, I'm going to focus on one of those economic reports, and that would be gross domestic product, or otherwise known as GDP. But before we get started, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. Gross domestic product, or otherwise known as GDP, is one of the very important indicators that every investor should focus on to get an overall sense of how the economy is performing. All the economic indicators, GDP is one of the more important reports that gives the investor a good understanding of where the economy is headed. It also can provide some previews of where there may be potential roadblocks or challenges for the economy to perform at its highest level. Before we dive into the weeds and understand more about GDP, it's important to understand what exactly is gross domestic product. Gross domestic product, otherwise known as GDP, is the total monetary or market value of all finished goods and services within a country's border for a given time period. Broad measure of domestic production, and it is a report card in a sense of the country's overall economic health. Typically, GDP is calculated on an annualized basis, but it also is calculated on a quarterly basis as well. For example, in the United States, the government releases an annual GDP estimate each fiscal quarter and also releases the same estimate for the calendar year. Data within the GDP report is communicated in real terms and is adjusted for price changes, which means that it is also subtracted for inflation. In the United States, the Bureau of Economic Analysis, otherwise known as BEA, pulls together data that is used from surveys of retailers, manufacturers, builders, as well as data regarding trade flows. Calculation of a country's GDP encompasses both public and private consumption, government outlays, investment, paid-in construction costs, addition to private inventory, as well as the balance of foreign trade. All the components that make up a country's GDP, the balance of foreign trade is especially important. GDP of a country tends to increase when the total value of goods and services that domestic producers sell to foreign countries exceeds that of the total value of goods and services that foreign producers sell to domestic consumers. When this situation occurs, a country is said to have a trade surplus. When the opposite occurs, a country is said to have a trade deficit. If you notice, for many, many years, the United States has operated at a trade deficit. There are a variety of GDP measurements that can be used for a variety of different situations. Nominal GDP is GDP that's evaluated at current market prices, either in local currency or in US dollars at current market exchange rates, in order to compare countries' GDPs in financial terms. GDP, or purchasing power parity, is GDP measured in international dollars using the method of purchasing power parity, otherwise known as PPP. It adjusts for differences in local prices and cost of living in order to have effective cross-country comparisons. Real GDP is inflation-adjusted GDP that measures the quantity of goods and services of an economy in a given year. It keeps prices constant in order to extrapolate out the impact of inflation or deflation over a specific time period. GDP growth rate compares 1 year or 1 quarter of a country's GDP to the previous year or quarter in order to see how fast an economy is growing. GDP per capita is a measurement of GDP per person in a country's population. It indicates the average output or income per person to be able to measure the average productivity or the average living standards within a given population. Given that GDP is calculated in monetary terms, it is impacted by inflation. Rising prices tend to increase GDP, but it's also important to understand that does not necessarily mean that there is any change in the quantities of goods and services that has been produced as a result of those changes in inflation. Therefore, it is important to take a deeper dive than just looking at nominal GDP, because it could be disguised that prices just rose and there really isn't any change or increase in the overall economic production of a country's GDP. GDP is used when comparing different quarters of output within the same year. When comparing GDP of 2 or more years, real GDP is used. Because of the removal of the influence of inflation, allows for the comparison of different years to solely be focused on volume. Overall, real GDP is a better method of being able to explain long-term economic performance. GDP is a widely used metric. There are other ways to be able to measure the economic growth of a country. While GDP measures the economic activity within the borders of a country, the gross national product measures the persons, individuals and corporations that produce within a native country, including those that are based abroad. National income, or GNI, is another measure of economic activity. It takes into account the sum total of all income earned by citizens or nationals, irregardless whether that income was generated domestically or abroad. We are now in a more global economy. GNI has been put forth as a much better metric to measure economic activity than GDP. GDP data, in theory, should not have much of an effect on the markets, as it is a rear-view mirror look at what has already occurred in the economy. Where it does have a major impact on the economy and the markets is if it is severely different from the expectations that investors, economists, and the market are looking for in terms of GDP data. For example, some of the severe market declines that have happened in recent memory are not related to any expectations of a different corporations or a different industry. Rather, it is focused on the differences between the expectations for what GDP is supposed to report and the actual numbers that GDP does report. That difference can fuel speculation that certain governmental agencies or Congress itself may act in a different manner than the markets are expecting to based upon the GDP data. GDP provides a direct indication in the health and overall growth of the economy. Many businesses use GDP as a part of their business strategy, while at the same time, government indices, such as the Federal Reserve, make policy decisions or monetary decisions based upon the GDP data. Growth rate is slowing. These government indices may implement a monetary policy to try to give the economy a boost. However, if the economy is robust, they may institute a monetary policy to try to slow down the economy and to ward off inflation. GDP is the indicator that says the most about the overall health of the economy. It is the data point that most economists, investors, and policymakers follow. Advanced release of this data will almost certainly always move the market, but that move can be limited based upon many of the factors that were outlined in terms of the difference between nominal and real GDP. Investors watch GDP as it is a great foundation for decision making in terms of where to invest. Profits and inventory data within the GDP report is a great resource for equity investors because it shows total growth during that period as well as pre-tax profits and operating cash flows. Comparing the GDP growth rates of different countries can play a huge factor in asset allocation, as it can provide you with information on which of the fastest growing economies abroad that you want to invest in. Here are the key takeaways in terms of GDP. What is GDP? It is the monetary value of all finished goods and services within a particular country during a specific time period. GDP provides an economic snapshot of a country which can be used to measure its size and overall growth rate. It can be calculated in 3 ways: expenditures, productions, or income. It can also be adjusted for inflation as well as population. It has many limitations. GDP is a key tool that many businesses, policymakers, and more importantly, investors use as a part of the framework for their decision-making process. You can use GDP data to help them make investment decisions. It is one of the most closely watched data metrics that help investors, businesses, and policymakers make decisions about where the economy is headed. As with anything, it is one key metric as a part of an overall strategy that you need to implement in terms of your investment portfolio. The key thing about GDP is to understand how it works and how it's going to help you make better decisions about you and your money. That is it. Hopefully now you have a better understanding of what GDP is, how it can impact many of the decision-making processes for investors regarding the economy, and how you can utilize this tool to make investment decisions for your own portfolio. Please don't forget to smash the like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. Thank you for tuning in.